When you want to build an algorithmic trading system, the first step you need to take is to define the strategy you want to build or implement. You must decide what you want to achieve and what market conditions you want to trade in. This will determine the type of algorithm you need to build. In defining your strategy, you have to identify market conditions first. Consider the current market conditions and identify which conditions are most favorable for your trading strategy. Market conditions play a crucial role in the success of an algorithmic trading strategy. Different market conditions may require different types of algorithms or different parameters within a single algorithm. There are several key market conditions to consider when choosing an algorithmic trading strategy, including market trend. Is the market in an uptrend, downtrend, or in a range? Different algorithms are designed to be more effective in different market trends. Volatility. How volatile is the market? High volatility can create opportunities for quick profits, but it can also increase risk. Liquidity. How liquid is the market? A liquid market may offer more opportunities for every trade, but it may also lead to increased competition and lower profit margins. Economic indicators. What are the current economic indicators and how are they affecting the market? For example, a strong economy may lead to a bull market, while a weak economy may lead to a bear market. News events. What are the current news events and how are they affecting the market? News events can have a significant impact on market conditions. The next thing you need to determine is your risk tolerance. Determine how much risk you are willing to take and what type of losses you can tolerate. This will help you choose a strategy that aligns with your risk tolerance. Determining your risk tolerance is an important step in choosing an algorithmic trading strategy. Risk tolerance refers to the amount of risk you are willing to take in your investments and the level of losses you can tolerate. There are several factors to consider when determining your risk tolerance, including investment goals. What are your investment goals? Are you looking for short-term profits or long-term growth? Time horizon. How long are you willing to hold on to your investments? A longer time horizon may allow you to tolerate more risk. Financial situation. What is your financial situation? Do you have other sources of income or savings to fall back on if your investments do not perform as expected? Personality. What is your personality like? Are you more risk-averse or risk-seeking? Once you have considered these factors, you can determine your overall risk tolerance and choose an algorithmic trading strategy that aligns with your risk tolerance. For example, if your risk tolerance is low, you may choose a strategy that focuses on consistent, low-risk profits, while if you have a high risk tolerance, you may choose a strategy that focuses on high-risk, high-reward trades. Consider what you hope to achieve with your investment, such as short-term profits or long-term growth. This will help you choose a strategy that aligns with your investment goals. When choosing an algorithmic trading strategy, it is important to consider your investment goals. Your investment goals will impact the type of strategy you choose and the type of assets you trade. Here are some common investment goals and the types of algorithmic trading strategies that may align with them. Short-term profits. If your goal is to make short-term profits, you may choose a strategy that focuses on quick trades, such as scalping or high-frequency trading. Long-term growth. If your goal is long-term growth, you may choose a strategy that focuses on longer-term trades, such as trend following or mean reversion. Diversification. If your goal is to diversify your portfolio, you may choose a strategy that trades multiple assets, such as equities, bonds, commodities, and currencies. Risk management. If your goal is to manage risk, you may choose a strategy that focuses on hedging, such as market neutral or statistical arbitrage. By considering your investment goals, you can choose an algorithmic trading strategy that aligns with your investment objectives and helps you achieve your desired outcome. Research and evaluate different algorithmic trading strategies to determine which one is best suited to your investment goals, risk tolerance, and market conditions. In order to choose the best algorithmic trading strategy for your needs, it is important to research and evaluate different strategies. This process involves understanding the underlying principles of each strategy and evaluating its historical performance to determine its potential for success. Here are some steps you can follow when researching and evaluating different strategies. Familiarize yourself with the strategy, research and understand the underlying principles of each strategy, including the types of assets it trades, the market conditions it is designed to take advantage of, and the potential risks and rewards. Review historical performance. Evaluate the historical performance of each strategy using backtesting or real-world performance data. Consider the strategy's win rate, average profit per trade, and maximum drawdown, among other metrics. Consider market fit. Evaluate whether the strategy is well suited to current market conditions and whether it has performed well in similar market conditions in the past. Evaluate simplicity versus complexity. Consider whether the strategy is simple or complex and whether it is suitable for your level of expertise. Consider ease of implementation. Consider how easy it is to implement the strategy and whether it requires a significant investment in software or infrastructure. By researching and evaluating different strategies, you can determine which strategy is best suited to your investment goals, risk tolerance, and market conditions. Backtest the chosen strategy using historical data to determine its potential for success in live trading. Backtesting is the process of evaluating a trading strategy by simulating its performance using historical market data. This is a crucial step in the process of choosing an algorithmic trading strategy as it allows you to evaluate the potential profitability of a strategy and determine whether it is suitable for your needs. Backtesting involves running a strategy against historical market data and recording its performance, including the number of trades, the size of each trade, and the overall profit and loss. The results of the backtest can then be used to evaluate the strategy's performance and make any necessary adjustments to improve its performance. Here are some steps you can follow when backtesting a strategy. Choose a data source. Select a reliable source of historical market data that is appropriate for the type of assets you want to trade. Set up a testing environment. Use a software platform to set up a backtesting environment and configure it to match the conditions of the strategy you are testing. Run the backtest. Run the strategy against the historical market data and record its performance. Analyze the results. Analyze the results of the backtest, including the number of trades, the size of each trade, and the overall profit and loss. Evaluate the strategy. Evaluate the performance of the strategy and determine whether it is suitable for your needs. Consider making any necessary adjustments to improve its performance. Backtesting is an important step in the process of choosing an algorithmic trading strategy, as it allows you to determine the potential profitability of a strategy and make any necessary adjustments to improve its performance before you begin trading with real money. Consider the past performance of the strategy, including any previous losses or gains, to determine its overall reliability and stability. Evaluating the past performance of a trading strategy is an important step in the process of choosing an algorithmic trading strategy. This process involves analyzing the historical performance of a strategy using real-world data to determine its potential for success. Here are some factors you should consider when evaluating the past performance of a strategy. Win rate, the percentage of trades that resulted in a profit. A high win rate may indicate a profitable strategy, but it is also important to consider the average profit per trade. Average profit per trade, the average amount of profit earned per trade. This is an important metric to consider, as it provides a more complete picture of the strategy's overall profitability. Maximum drawdown, the largest decrease in value experienced during the trading period. A high maximum drawdown may indicate that the strategy is riskier than one with a lower drawdown. Risk-reward ratio, the ratio of potential profit to potential loss. A high risk-reward ratio may indicate a profitable strategy, but it is also important to consider the win rate and maximum drawdown. Consistency, the consistency of the strategy's performance over time. A strategy with consistent performance may be more reliable than one with volatile performance. By evaluating the past performance of a strategy, you can determine its potential for success and make an informed decision about whether it is suitable for your needs. It is also important to keep in mind that past performance is not necessarily indicative of future results, and that there are many other factors that can impact the success of a strategy. Continuously monitor the performance of the strategy and make adjustments as needed to ensure it remains effective over time. Continuously monitoring and adjusting the algorithmic trading strategy is an important part of the overall process of algorithmic trading. This involves regularly monitoring the performance of the strategy, making any necessary adjustments, and tracking the results over time. Here are some steps you should follow when continuously monitoring and adjusting your algorithmic trading strategy. Regular monitoring. Regularly monitor the performance of the strategy to ensure that it is functioning as expected. This may involve tracking metrics such as profit and loss, win rate, and maximum drawdown. Detecting and addressing issues. Detect any issues or discrepancies in the performance of the strategy and take appropriate action to address them. This may involve making adjustments to the strategy or modifying the parameters used in the backtesting process. Keeping up to date. Keep up to date with the latest market conditions and developments, and make any necessary adjustments to the strategy to reflect these changes. Re-evaluating performance. Regularly re-evaluate the performance of the strategy to determine whether it is still performing as expected. This may involve running additional backtests or using new market data to test the strategy. By continuously monitoring and adjusting the algorithmic trading strategy, you can ensure that it continues to perform well and meets your investment goals over time. It is also important to be patient and not make too many changes too quickly, as this can impact the overall performance of the strategy.